Welcome back to Built to Sell, Built to Buy. I'm your host, Sam Penny, and today's conversation sits in a place most founders and buyers actively avoid until it's too late. My guest, Ryan Finley, founder of Freedom Financial Services Group. Ryan is a CPA, a certified valuation analyst, and a forensic accountant who specializes in one of the most commercially dangerous intersections in business. It's divorce and ownership. Now, Ryan works with founders, investors, and advisors when personal breakdown collides with enterprise value. Situation where businesses stall, deals die, and years of hard work quietly leak out through legal blind spots. This episode, it's not about drama. It's about risk, structure, and protecting what you've built. If you own a business, plan to buy one, or want your company to survive beyond you, listen carefully. Ryan, welcome to the show.
Thanks for having me, Sam.
Now, this isn't my normal podcast. It's, divorce and business and entrepreneurship is always a touchy kind of area. But I think that it's an important conversation to have because it's not just divorce, it's also putting in a lot of strategies to protect assets as a founder. And most founders are very bullish about what they're going after, trying to, grow at all costs without forgetting to put things away. But firstly, I want to understand, how on earth did you get into this situation and this business that you've started? Like, why divorce and working with founders?
Great question. I get that asked quite frequently, actually. So my background started off as an accountant in a public accounting firm, and then I went to work for a company buying golf courses and resorts and athletic clubs. And I was in the new business development group of that company. So that early training of going out and doing financial forecast and due diligence and then transitioning over. So, that helped a lot valuing business and seeing what's important, seeing how important cash flow was and consistency and everything. So I did that for 10 years. And then I was, transitioned over to land developing and construction, and would have been CFOs of residential development companies, commercial development companies. And then, I was doing that. And then about 6 years ago, I had a friend that was a divorce coach. And she said, I've got this difficult case. The financials are complicated. The guy owns a business. We're having trouble valuing it and seeing what a distribution of assets would be. Can you help me with this? And so I helped her with this case, and then she had another one. And then just, I was good at taking a complex financial situation and explaining it to a person that was a non-financial person. And that kind of, I started helping her in the evenings and on weekends, and just kind of got into that. And so I've been doing this about 6 years now, and it's my background seems to have fit everything that perfectly for this role.
So you've obviously now worked with many, many clients. Are there patterns that you often see throughout?
There is. There's patterns, and if you think about divorce, and no one likes divorce, and I meet some wonderful people in a bad situation. But you think about a divorce, this is your best friend that was your best friend for so many years, and all of a sudden they're suing you for divorce, and then you're having to divide everything up. And there are patterns here. It's anger a lot of times, and then a lot of times there's businesses involved, and how do we share assets, and am I going to be okay after this? And family concerns and things that emotional baggage and emotional decisions. And so if there wasn't the emotion part in it, it would be easier to do. But there's, instead of a financial situation, you've got emotional issues to deal with.
Yeah. Obviously, divorce is a pretty terrible thing, and particularly when there's assets that are real personal assets like a business. How do you first go about understanding what that financial pool is, and then starting to work through that valuation of a business?
Well, there's different roles that I have. As you mentioned, sometimes I represent a person, sometimes I'm doing litigation support, and then sometimes I come in to evaluate different appraisals. If, depending upon what hat I'm wearing that day, if, for instance, but as an, a valuation analyst, what you're trying to do is get your arms around the business, steady up the cash flow, get normalized expenses, and try to figure out what the best value of that is. And that's what I would encourage most people to do. If you own the business before you get married, if you're getting married, I mean, nobody plans to fail, nobody plans for a divorce, but I would suggest that somebody get a baseline valuation for any major event that in their life. If they're getting married and they have a business separate, get a valuation, get an independent valuation as you're going into that marriage. It does a couple of things. It establishes a premarital value or a baseline.
Obviously, there's a lot of emotions that go into this. Does bringing that valuation in early take out a lot of the emotions when it comes to that separation?
I think it does, because divorce, there's a lot of distrust in divorce. And if you can bring that valuation in early, then that kind of increases the trust or decreases the mistrust. And so there's things that if you bring it in early, then that shows good faith, and it increases the trust. And so you're not hiding revenues. You're not delaying contracts. You're not inflating expenses. Those are the kind of things that help the process of divorce. I've seen many people try to devalue their company because they're going through a divorce. And, I take the approach of honesty and trust, because if somebody hires me to come in, I'm going to find that stuff anyway. You can try to hide it. I'm going to find it. We're pretty good at that stuff, really good at that stuff. So, I would think the more open and honest, I think the more efficient the divorce will go, the more efficient business valuation go, and the lower the legal expenses.
Trust is obviously a very big thing. And when you've in a relationship, when you're in a marriage, you've got a founder who's working hard on building their business, building that asset. You've got the other person as well, though, that is there supporting you throughout that time. And I know, running my own companies for 25 years, being a founder, you're not necessarily the nicest person to be around all the time because it's hard. You never switch off. What kind of person starts to hide assets? And you being a forensic accountant, you've seen it all. What would be the reasons when someone starts to perhaps hide assets, manipulate what that valuation is? What is what's the situation there?
And you're right. When someone starts a business, it consumes your life. You're never off work. You're always working. Even when you're home, you're thinking about your business and things going on. And you have a spouse that's, for the most part, has a job or taking care of the family, doing other things just as important. And so, you do have, it starts getting, as the business builds up, people start, if the marriage isn't going smoothly, they start planning, what do I do? How can I preserve this for myself? And that's kind of when we see things that we see, I've got a bunch of different stories. I can give you examples, but, a couple of them are, people postponing contracts or running personal expenses through the business or not disclosing all their revenue, or, there's just a bunch of different things. But it's kind of, they're planning for their divorce, to be honest about it. And they're trying to preserve money that post-divorce they can bring back in, that they don't have to share, because basically the business in most cases is a marital asset.
Divorce is probably one of the greatest risks to a business, particularly in the continuity. The founder loses focus. They start to lose interest. They start to be very not that pleasant to be around in the workplace. From your seat, what do you see founders going through when they're going through one of these situations?
Well, it's a major distraction. And what the thing that needs to happen in this, that a lot of people lose focus on, is that the business needs to survive this divorce. It's a difficult time for everybody, the business needs to survive. And so the more they can keep business as usual and normal business with employees and contracts and customers and things like that, the better off everybody's going to be at the end. Um, but typically, um, you would like to say that it's just a disagreement between the parties, but a lot of times there's a third party involved, whether the spouse has a boyfriend or this one has a girlfriend or something like that. Sometimes that interferes with this process as well. And so you've got a business, you've got some emotional baggage that's really losing the focus of the owner. So on top of having to run the business, they're going through a divorce and they're having to worry about preservation of assets and everything like that. And if somebody else is involved, then that's even a bigger distraction. So, the owners, instead of keeping their focus on the business, a lot of times there's different hurdles or distractions that they have to overcome in addition to running the business. So,
Are there any strategies you think that can really help the founder through this whole process to maintain focus, to maintain running that business and not necessarily having the business continue to keep expanding? But what should a founder do when they're going through this really difficult time?
it's a difficult question because, if it's possible to keep business as normal, if there's, and just keep it solid and going forward, that would be easy. But, it's not that easy because there's emotional decisions involved. There's children, there's, you know, uh, potential spouse support. There may be things with the cash flow that affect the business. If in a division of assets, other than the business, there may be other assets in this marriage that they have to divide. And there may be, there's kids typically. So, it's the advice I would give an owner. I tell people to try to take the emotion as much out of the equation as you can and just look at black and white. What is a good business decision? I'm not trying to manipulate things here, but just as a business owner, what's the best business decision I can make, taking all the other distractions out of the equation.
So, that marital support that someone provides throughout the marriage often gets discounted, gets discredited. The founder says, "This was all me. You have no right to it." Do you give any advice in those situations?
Well, in most situations, the business would be a marital asset. And so, there is support that the family obviously is successful because of the business and the sacrifices the owners made and the families made and everything. But at the same time, you know, there is another spouse involved and there is, who's made sacrifices as well, along the way. So, I'm a business owner myself. I would like to preserve as much as I can, but at the same time, in all fairness, you try to, from a CDFA and a CPA perspective, we still try to promote fairness. I understand, I would like to say there's a magic formula to preserving the business for the owner. But at the same time, I think fairness needs to be called into, you know, truth here and just to make sure that everybody's taken care of. If somebody gave up their career for someone else to run a business, then, they don't have the means or the income to live the life that they've grown to as well. So, you know, there's no magic formula, I guess.
Obviously, you're an accountant, not a psychologist, Ryan, but being able to
God,
take a lot of this, being able to take a lot of the emotions out of this whole conversation and between the two parties, is there a way where you can reduce the emotions, reduce people making stupid mistakes, being unfair to the other party?
I think so. I think I do mediations as well, Sam. And so what I try to do is I have this big television screen and I put my spreadsheets up on this television screen. And I think when people can see it in black and white, if you do this, this is the cause and this is the effect, and this is how the math equation balances out. I think when they can see it in black and white and just see it in front of them, it helps kind of take the emotional equation out of the decision. So, you know, I try to I try to promote that as much as possible. Just saying, you know, if they're in a mediation, sometimes you get an offer over and they can't think clearly because they're so angry or they're so frustrated. And I try to get them just to, hey, look at this. Here's what this means. If we do this, then this is the effect of it. This is what you get. This is what they get. This is how it balances out.
Obviously, a business is very much part of that person's who they are, their DNA. Are there any real dangerous assumptions you think that the founder is trying to keep the business separate? It's not part of the pool. What kind of assumptions do they make?
That's a hard one to answer because it's a lot of them. I see it being difficult for them to separate the business because it's such a significant part of the marital asset a lot of times. And so I see owners doing things like manipulating documents or overstating expenses or not disclosing a contract or deferring revenue, things like that, you know, they normally wouldn't do. It isn't a good business decision. And I would frown upon that and discourage that as much as possible, because if you're going through a divorce and those kind of things pop up, it's going to cause more legal expenses because then the attorneys and the forensic accountants and places like that will dig in and dive even deeper. And that's more of a disruption for the business than, if the things were clearly disclosed.
When it comes to that, like you said, you're doing mediations, you're putting the spreadsheet, the balance sheet up on the screen. And obviously numbers don't lie, but obviously in a lot of circumstances they do. When we're going through this process, and you must see it quite often where the non-founder party of this relationship is really trying to force the sale of a business, because the most important thing is to try and retain that asset, the business, to keep running. Under what circumstances do you really see where there is a forced sale of the business?
Yeah, I don't see that very often because I think most judges and mediators say, don't kill the goose that lays the golden egg, because, it's such a big part of the asset. You want to keep that going. And, a lot of the small businesses, it's the value is based upon the owner and their knowledge and their experience and some of them may have professional licenses. So if you sell the business in those situations, then a lot of times it decreases the value. So you don't have the asset typically that you would. So, I would encourage people to find another way to distribute value. If there's a different asset, where the owner keeps the asset in exchange, maybe there's a property or some 401ks or some other investments that can be given to the spouse to, offset that value. When you start dividing the marital estate, what would an equitable distribution of that be? Well, if you put the business in spouse one's column and give some of the other assets to spouse two, then, that may be a better way to divide the assets and a better way to keep the business alive and keep, because the divorce affects other people too. You've got employees of the business, you've got customers, you've got other owners. There's things that, that if that business gets hurt, it affects other people.
Entrepreneurs are a very unique breed of person. They often think that it's all them. Nobody else contributed. At what point do you need to talk a founder down from saying there's actually two of you in this whole relationship, two of you building this business? What words of advice do you give to that founder at that time?
I see that a lot. And that's a hard conversation to have because you're right, because a lot of it's built on their expertise and their knowledge and everything. But you're right, there is another person that's has sacrificed a lot for that success of that business. And so, you do need to remind them that you wouldn't have the time, you wouldn't be able to do the things you're doing without that support. And, a lot of them fail to recognize that. And a lot of them, it's hard for them to realize that. Um, but I see that quite frequently. That's a hard conversation to have. And, sometimes you just have to say, it is a marital asset, and the best thing to do, in the state or country or region we're in, here's how the judge is going to see it. So we can either divide this, you know, friendly, or we can take it to the judge and have the judge do it. And it may not turn out as well if we go that far.
Okay, let's talk about that, because obviously divorce wipes hundreds of thousands of dollars out of the whole marital pool. And you see, and you must see it a lot, where two warring parties, because they can be at war at times, where this whole process can last for a couple of years, even a few years. How do you try and head that off early on in the process, making them realize that if we keep going on like this, we're going to wipe a few $100,000 off what you're potentially going to share?
You're exactly right, Sam, because it usually takes 2 years, and it usually affects a couple of 100,000. And it's right, because they have a finite amount of assets, and that they're trying to divide. And that keeps getting decreased by, the divorce, the legal fees, the professional fees, the distractions from the business where you're not able to run the business. So you're actually, by the time this is over, the division of assets is much smaller because it's dragged out, because of the distractions, because of the legal fees, just things that happen. And if up front, I talked initially about doing an appraisal when they got married, and if you could do an appraisal, at least an independent appraisal, when you start going through this process, at least you would have your arms around kind of what you're arguing over, and not have to go back and forth with the attorneys as much.
The worst outcome in the whole process is ending up in trial. What is it that sees people ending up before a judge?
Thankfully, a lot of them don't get that far because, they do realize, cooler heads prevail eventually, that, hey, this has cost me this much today. If we go to trial, it's going to be this much more, or, we can sit down and finally negotiate. So it's kind of like, finally some of these people when they get that far down the road, they start getting some sense, is that, if I don't divide this now, the outcome may be the same, but we may have less to divide, and it's going to be a whole lot more legal expenses. So, thankfully, maybe 10 or 15% of these actually go to trial. Not as many of them go to trial as you would expect.
But you must see it so often, people squabbling over something so small that ends up going to court, where they're going to spend $50,000, $100,000 on legal fees, barristers. I assume you call them barristers in the US. How do you talk people off the edge of going to trial over something that the cost benefit does not outweigh the outcome?
And that's the most frustrating thing, Sam, is sometimes you get a spouse that is so angry that their spouse is leaving them. It's more like a scorched earth. They don't care what it costs. They're out to get even. I'm hurting, so I'm gonna hurt you. And you see that, and you try to get through that. And that's where we need a therapist. It's I'm a financial guy, I'm not a therapist, but that's a lot of times it's hard to get to that. And you keep trying to explain to them that, this is not a good decision for you. So, let's go back to the spreadsheet. If you go this far, your assets are going to be this. You're finding diminishing returns on what you're throwing out there. And but sometimes it's, again, we've talked about taking the emotion out of these decisions, and sometimes there's just so much anger that the emotion won't come out. And it's more of, like I said, it's more to prove a point or to get even. And I hate those cases because nobody wins. Nobody wins except the attorneys and the analysts.
There must be a lot of irrational decision making that goes on, not just from the founder, but from the other side. Give me some examples of some of the absolutely ludicrous things or decisions that people have made.
I've got some good ones. I'll tell you one from an owner's perspective is that I had an owner that overpaid his IRS taxes by $1 million. And so his thought behind it was, we're going to file this tax return. The divorce is going to be filed. Then I'm going to file an amended tax return and get that money back, But then when you catch somebody doing that, it's just, we talk about trust again. There's no trust. And then that shows there's a sign to manipulate the divorce, and then once that happened, then the legal fees, what else is he hiding? What else is out there? So then it just got unbearable on a situation like that. Other cases I've seen, I've seen, what we call dissipation of assets, where an owner will have, in this situation that I'm thinking of, had a girlfriend or two and was spending a lot of the business money supporting that girlfriend, and so that's marital money going for a non-marital purpose, which is dissipation. And it's also coming out of business. So it's, those are things that are really bad decisions. In addition to the infidelity, it's just blatantly throw it into the spouse's face. I'm doing this and I've got it here. It's in my books. I've spent money on this person. I've done this. We've taken these trips. I see that a lot actually, where somebody's using business money to entertain somebody they shouldn't, trips and gifts and things like that.
Obviously, you're an accountant where your world, you would love it to be black and white. You would love it to all show on a balance sheet or a profit and loss or a cash flow where the numbers don't lie. And the main theme that you've been speaking about today has been trust. But it's very difficult to have trust when you've got these kinds of situations going through. I assume then that it's when there is no trust set up right at the start of these proceedings of a split, of a separation. Are they the ones that always go through to trial, or is there a way where you can head it off early and make this come to a completion very fast?
Yeah, those are the ones that have a higher percentage to go to trial. But as I mentioned earlier, most of them last long enough and go through mediation 2 or 3 times that they finally come to a resolution. But, there is, if it is truly a divorce, Sam, and it's just 2 people that just don't get along, and if they're able to communicate, and I do have a lot of these too, where, we're just going to throw everything out there. We're going to divide it and we're going to do fair. We're going to have a fair and equitable distribution of our assets. We're going to talk about our parenting plan, child support, everything's on the table. Those are the ones that are the easiest to go through, and they're the shortest ones. And they're the, one of the things we haven't mentioned through this is if there's 2 spouses involved, if there's kids involved, if these spouses still have to parent together, and if you're butting heads and if you're hating each other, you still have to parent. You have to go to football games and basketball games and cheerleading practice and things like that and see the other person. And it's just, the more that they can communicate and just put everything on the table and just negotiate this thing and be fair, the better life is for them. Because, there's post divorce, there's still life, there's still kids, there's still relationships. You've had You have friends with them, you have family with them, you have kids with them. You just still have, they're still going to be a part of your life.
Running a business takes an immense toll on on you as the founder, a relationship, the family life, but also then this whole separation process goes through everything and takes a significant toll on everybody around you, employees, kids, both parties. How do you ensure that the personal disruption is minimized through all of this?
I think it's communication and inclusion, Sam, that best answer, because these owners aren't working 40 hours. They're working 70 hours, 80 hours, and it does take away from family time. So I think, if they're able to communicate with their spouse and just say, hey, here's what my week looks like. Here's what I've got going on. Here's the business. Here's how the business is doing. Here's, what the big project we had when we just completed. Here's how our year was. I think just being able to communicate and to, you know, uh, let them know, including them in your business. I think that helps more of an understanding on why you're away from home or why things are tough. And I think it's my best advice for them.
Have you seen any situations where the business has been stronger coming out of a divorce?
Not from my personal experience. Not, I haven't. I haven't. Because and maybe it gets back to that after a year or two, but immediately I would say no, because I think a divorce is very hard on a business, and most businesses, most small businesses. And there's some that are large enough that they may have enough people running them where that would be a much of a distraction for them. But I think most small businesses, it's enough of a distraction that it takes a toll on the business and a toll on the owner. And I think it may take a couple of years after that to kind of get things back to normal and get their customers going and get their everything, the employees satisfied and situated and settled. It's just, I think it's a wound that takes a little bit to heal, is the best way I can say it.
As a founder, we're always trying to minimize risk and identify all the things that could be damaging to the business. But I assume that we're not throwing into the mix the risk of a divorce. And even if it's not on the radar, do you find that pretty much all entrepreneurs never plan for it?
I would say it's 90% true or 100% true or 99% true. It's, you know, I don't think anybody plans for a divorce. And I think a lot of times that you don't realize the situation. I think sometimes one spouse may think things are okay and the other spouse drops a bomb on them and says, no, you're not home. You're not doing these things. You're not paying attention to the kids. I'm doing all the housework. I'm not happy. And I think, like I said, sometimes they may not see it coming. But you're right. Nobody plans for a divorce, and I wish it wasn't part of the equation, but unfortunately, it is.
A great strategy, and you would know, Ryan, being an accountant, increasing the valuation of a business is all around key person risk and making the business founder independent. I always teach that strategy to every founder to try and make themselves independent from the business, from the day to day. Do you see that as a key strategy when this unfortunate situation arises?
I agree with you. I wish more of them would take that advice, Sam. I really do, because if they were more independent from the business, then the business could operate more on its own. It wouldn't be as dependent upon the owner, and divorce wouldn't be as big of a distraction as it is most of the time.
Effectively, Ryan, when we're going through the whole separation, going through the divorce, being able to minimize the disruption to a business, if we build a business effectively that we're wanting to sell, where we're putting in place a lot of these strategies of key person risk, building the IP, the assets, all those great things that go into a business. Because obviously, when we sell a business, we're removing that founder from the whole process. If we set a business up right at the start to one day be sold, to put in all of those right structures in place, is that, I guess we can't say the golden bullet to make this process a lot easier, but is that something every founder should really put in place right from the start, regardless of whether there is a divorce on the horizon, or even if they're not planning for it, but always building a business that they could easily just open the books, there you go, if they're selling it to someone else?
Think that should be the goal of every entrepreneur, I think, because you should have some type of exit strategy out of your business. And I think that's what you're describing, where I can build this up 20 years and I can sell it and retire or start another business, whatever I want to do. But that gives me an exit strategy at the end where it's not as dependent upon me, but it's just, I think a lot of these businesses that going through divorce that I handle are more hands-on to get to that point. I think that's the eventual goal, but I think they're heading down that road. But that you're right. That is the eventual goal, I think, of what every entrepreneur should shoot for. Then the business has a valuation, and we're able to, if a divorce comes up, you're able to split that asset fairly easily.
All right. Before we wrap up, Ryan, what do you think are three great strategies, pieces of advice that you have to any founder, but also to the other party?
Three strategies. I think, disclosing everything. I think, being as upfront as you can on your business. A lot of people will probably disagree with me on that because they're trying to preserve their business. They want to lower the valuation of the business so they'll get a bigger piece of the pie. But I think, if you're going through a divorce, and again, we talk about trust and emotions and things like that, the more you can develop trust and maintain trust between you and your spouse and the attorneys and everybody involved, I think it makes it a cleaner and easier process. Emotion, if we can go back to making this more of a business decision instead of an emotional decision and be able to take that out of the equation, I think that's part of the second one. And then third is, you do have to parent with these people, with your spouse. And so I would keep that in mind too, that if you're going through a divorce, you're going to have kids together. This is something that you're going to be going to weddings and grandbabies and things like that you're going to have to deal with the rest of your life.
Ryan, I really appreciate that you've come from a position of fairness as opposed to effectively representing the arsehole entrepreneurs. Because I tell you what, there are a lot of them out there, but also on the other side, there can be arseholes in a lot of this. I really appreciate the approach that you take in fairness, in trying to bring truth and trust throughout the entire process.
Thanks, Sam. I appreciate that. And, when you invited me on the show, I was thinking about what we would talk about and everything. And I do see a lot of owners, and there are a lot of ways to manipulate valuations of businesses, things like that. And it's hard for me when I represent both sides to be able to suggest that or things. Honesty is, in my opinion, is probably the easiest and best way to go through this. It's hard to be, there was a lot of things, if I was in their shoes, there was things I would, that would be hard to not do, if that makes sense.
Absolutely. Ryan, this has been a powerful but also a very necessary conversation. What stands out is how quietly value is lost, not through bad strategy, but through unplanned life events and structural blind spots. This isn't about fear, it's about ownership, foresight, and protecting years of work. Now, for anyone listening who owns a business, plans to buy one, or wants their company to survive beyond them, this episode should change how you think about risk. Now, Ryan, where can people learn more about your work or connect with you at Freedom Financial Services Group?
Thanks, Sam. Thanks for having me on the show today. I appreciate it. The best way to reach me is probably through my website, which is www.freedomfsg.com. My email is ryan@freedomfsg.com.
Excellent. I'll make sure I put all those links into the show notes. And thanks for joining us on Built to Sell, Built to Buy. I'm Sam Penny, and this is a work that separates fragile businesses from durable ones.